Imagine someone who has smoked 2 packs a day for decades, weighs 350 pounds, and is now lying in the ICU. That's the picture of America's financial health today. The U.S. economy is still alive, but it's hooked up to machines, struggling to breathe, and every doctor in the room knows that one wrong move could be fatal. Right now, the U.S. national debt has passed $33 trillion. To put that into perspective, that's actually larger than the combined economies of Europe, Africa, and South America. It's not some distant problem decades away. It's here, it's real, and honestly, it's growing faster than ever. For decades, people assumed that the dollar could never fail, that U.S. debt was the safest bet in the world. But what happens if that assumption gets shattered? Because behind every government check, every social program, every defense budget, and every imported product is one simple fact. It's all tied to debt. This is no longer just about numbers on a spreadsheet in Washington. It's about whether the U.S. can keep paying its bills, and what happens to the global economy if the world's safest borrower suddenly stumbles. For nearly a century, the United States dollar has been the backbone of the world economy. Every country, whether ally or rival, has relied on it. Pension funds in Europe, sovereign wealth funds in the Middle East, and central banks in Asia all stacked up United States Treasury bonds. Why? Because the dollar was seen as unshakable. Think of it like this. If you're going to store your life savings, you'd put it in the safest vault you can find. For the world, that vault has always been United States debt. The returns may not have been exciting. A typical Treasury bond pays just a couple of %, but the chance of losing your money was close to zero. That's something no company, no matter how big, could ever guarantee. This system rested on one core belief: America would always pay its debts. As long as that trust held, the global financial system could function smoothly. International trade routes, shipping contracts, oil sales, and even entire currencies operated under the assumption that the dollar would never collapse. But here's the catch. Confidence is fragile. It lasts only as long as people believe in it. Once cracks appear, the foundation everyone has built on starts to look a lot less secure. And those cracks began to form not in theory, but in practice, especially after 2008. To understand why America's debt has exploded, we need to look back at 2008, the year of the worst financial crisis in 80 years. Banks were collapsing, housing markets were in freefall, and the United States government had a choice: either spend massive amounts of money to stabilize the system or risk total economic collapse. To understand why America's debt has exploded, we need to look back at 2008, the year of the worst financial crisis in 80 years. Banks were collapsing, housing markets were in freefall, and the United States government had a choice: either spend massive amounts of money to stabilize the system or risk total economic collapse. So Washington opened the floodgates. First came the $700 billion bank bailout package, followed by an $831 billion Recovery Act filled with tax cuts, infrastructure projects, and direct support for households. These programs worked. The bleeding stopped, the economy stabilized, and confidence returned. But the United States didn't walk away with just a patched-up economy. It walked away with a much larger credit card bill. From 2008 to 2020, federal debt rose by more than 30%, reaching around $80,000 per American in public debt. And yet, during this period, hardly anyone panicked. Why? Because interest rates were near zero. Borrowing was so cheap that even trillions in new debt felt manageable. Investors around the world continued to pour money into U.S. bonds, treating them like the safest savings account on earth. But every strategy has a cost. When you borrow heavily during the good times, you leave yourself vulnerable when things get tough. And then came 2020. The pandemic slammed the brakes on the global economy. To keep households and businesses alive, Washington spent trillions more, pumping another $5 trillion into the economy in just a few years. That's an extra burden of about $15,000 per person. For the first time since World War II, U.S. debt climbed above 100% of GDP. The once manageable problem had now become a runaway spiral. And as we'll see, the real issue wasn't just the size of the debt, it was the growing cost of keeping it alive. Here's where the story shifts from worrying to dangerous. For years, America's debt looked sustainable because borrowing was cheap. But today interest rates are no longer near zero, and that changes everything. Here's where the story shifts from worrying to dangerous. For years, America's debt looked sustainable because borrowing was cheap. But today interest rates are no longer near zero, and that changes everything. Right now, the United States government is paying over $1 trillion a year just in interest. That's actually more than the entire defense budget. Put another way, the government shells out around $3 billion every single day just to cover interest payments. And well, that number just keeps climbing. At the same time, some of the biggest foreign buyers of U.S. debt are quietly backing away. China has cut its holdings by more than $300 billion. Japan by about $200 billion. Even allies like the United Kingdom and Canada have turned into net sellers. When these countries reduce their demand, it means two things. First, the United States has to offer higher interest rates to attract buyers. Second, the dollar itself begins to feel less stable. And once confidence starts slipping, the effects ripple everywhere. A weaker dollar means imports get more expensive. The U.S. brings in nearly $4 trillion worth of goods each year. Fuel, food, electronics, and more. If the dollar drops, all of it costs more. Inflation rises. Shipping contracts, oil prices, LNG deals, refinery margins, even freight insurance. All of these get reshaped by higher borrowing costs and a shakier dollar. It's like a crack in a dam. At first it looks small, but if pressure keeps building, the entire structure can suddenly break. And you know, history gives us a warning of what happens when that confidence finally collapses. History shows us what happens when debt and confidence collide, and it isn't pretty. Take Venezuela, for example. At the start of the 2000s, it was the richest country in South America, flush with oil money. The government borrowed freely, betting that high oil prices would always cover its debts. But when oil collapsed, so did investor confidence. The result? Default, hyperinflation, and people carrying sacks of cash just to buy bread. History shows us what happens when debt and confidence collide, and it isn't pretty. Take Venezuela, for example. At the start of the 2000s, it was the richest country in South America, flush with oil money. The government borrowed freely, betting that high oil prices would always cover its debts. But when oil collapsed, so did investor confidence. The result? Default, hyperinflation, and people carrying sacks of cash just to buy bread. Now, the United States is not Venezuela. America, you know, has the world's largest and most diversified economy, while Venezuela relied almost entirely on oil. But the lesson here is pretty clear. When an economy leans too heavily on just one pillar, whether that's oil or, in America's case, the world's faith in the dollar, fragility really starts to set in. A more relevant example, perhaps, might be Greece during the Eurozone debt crisis. By 2010, Greece owed more than it could ever realistically repay. Interest rates spiked, investors fled, and the country had to be bailed out by its European neighbors. For Greek citizens, that meant harsh austerity, cuts to pensions, mass unemployment, and, honestly, years of economic pain. The United States is far larger than Greece, but here's the scary part. The dynamics are actually pretty similar. When debt soars and creditors start asking tough questions, confidence cracks. And once confidence fades, no amount of "we'll pay you back later" can really calm the markets. These warning signs show us what can happen when faith in government debt starts to slip. And right now, the dollar's role as the world's ultimate safe haven is being questioned in a way it hasn't been in nearly a century. So the U.S. dollar isn't just America's currency. It's the world's safety net. Central banks everywhere hold dollars in their reserves so they can stabilize their own money in times of crisis. If the value of their currency falls, they dip into dollar reserves, buy back their own money, and restore confidence. Honestly, it's like having a fire extinguisher in the corner of the room. You hope you never need it, but when flames break out, it can save the house. The U.S. dollar isn't just America's currency, it's the world's safety net. Central banks everywhere hold dollars in their reserves so they can stabilize their own money in times of crisis. If the value of their currency falls, they dip into dollar reserves, buy back their own money, and restore confidence. It's like having a fire extinguisher in the corner of the room. You hope you never need it, but when flames break out, it can save the house. This system, well, it only works because everyone trusts the dollar. But what happens if that trust weakens? The fire extinguisher doesn't work anymore. and the whole global system is at risk. That's why today's cracks in confidence matter so much. Countries are already experimenting with alternatives. China is pushing yuan-based trade deals. Some nations are increasing their gold reserves. The EU is encouraging more use of the euro. Digital payment systems are slowly emerging as backups. None of these has dethroned the dollar yet, but each one chips away at its dominance. For the first time in a century, the idea of a post-dollar world is being taken seriously. And that matters, because the dollar's reserve status gives America enormous power. It allows the United States to borrow cheaply, to fund deficits, and to wield sanctions with global force. If that edge erodes, America's financial playbook changes overnight. Which brings us to the tough reality. Washington doesn't have unlimited options. The choices it faces are both limited and painful. So what can the United States actually do about this? The options are few, and neither is attractive. The first path is cutting spending. On paper it sounds simple. Spend less, borrow less, and slowly shrink the debt burden. But here's the catch. Most federal spending isn't on bloated bureaucracy. The biggest items are Social Security, Medicare, and defense. Cutting these would mean reducing retirement checks, healthcare coverage, or military power. No politician wants to stand in front of voters and say, "We're going to take away your benefits." That's why since the 1980s, America has only run a budget surplus in 4 years. Every other year, the debt grew. The second path is printing money. The Federal Reserve can, in theory, create unlimited dollars and use them to buy government debt, but this is the most dangerous option. Expanding the money supply without discipline can trigger runaway inflation. Investors who buy United States bonds don't just care about the interest payments. They care about the dollar's value. If printing gets out of hand, foreign creditors will dump you. Even smaller efficiency campaigns barely make a dent. For example, a recent government initiative that promised $40 billion in savings sounded big, but that only covers about 10 days of interest payments. Even a massive $1 trillion cut would barely pay for a single year of interest. This is why Washington faces such a brutal dilemma. Either make unpopular, painful cuts now, or delay, and risk an even more devastating financial crisis later. And that brings us to the final, critical question at this crossroads. Can the United States rebuild trust and secure the dollar's future, or will hesitation push the world into a new financial order? The United States now finds itself at a historic fork in the road. On one side lies the chance to restore confidence, to prove that the dollar is still the world's anchor. On the other lies the risk of sliding into a cycle of mistrust, higher borrowing costs, and declining global influence. And that brings us to the final, critical question at this crossroads. Can the United States rebuild trust and secure the dollar's future, or will hesitation push the world into a new financial order? The United States now finds itself at a historic fork in the road. On one side lies the chance to restore confidence, to prove that the dollar is still the world's anchor. On the other lies the risk of sliding into a cycle of mistrust, higher borrowing costs, and declining global influence. Rebuilding trust won't be easy, but it's possible. It would require Washington to show discipline that hasn't been seen in decades. That means addressing spending at its core, putting long-term fiscal reforms on the table, and signaling to the world that America can live within its means. But the clock is ticking. Every year of delay makes the problem harder. Already, interest payments are crowding out investment in things that actually build the future: infrastructure, education, technology. Instead of funding growth, more and more money is simply being burned to service the past. If America can't turn the tide, the consequences won't be gradual. They'll arrive suddenly, like a dam giving way after years of cracks. A sudden loss of trust in the dollar would reshape not just the United States economy, but the global system that has relied on it for nearly 80 years. So the question isn't just about numbers or balance sheets or debt ceilings. It's about trust, the most valuable currency in the world. And right now, that trust is running thin.